just wait one moment as we let everyone into this webinar, and I'll get kicked off with introductions shortly. Well done for those of you who are particularly prompt and early birds to this exciting talk today. Right, so welcome, good morning, good afternoon, good evening, depending on whereabouts in the world you are. I'm very pleased to be here today. My name is Paul Adams. I'm the Director of Financial Inclusion Innovations for Poverty Action. I'm really here just to introduce everyone and to turn the floor over to them and get their insights on what I think is a really interesting webinar focused on a report we launched recently with SIGA and the Digital Credit Observatory on mobile instant credit, the impacts and the challenges and the lessons for consumer protection. The report is fascinating, and I encourage you all to read it after this webinar, not now. It manages to sort of define and locate mobile instant credit amongst all the other forms of credit there are in the world. It assesses the recent evidence on the welfare impacts of mobile instant credit, as well as the potential consumer protection risks, such as debt distress and post-contractual exploitation, things like that. What it also does is assess recent attempts to monitor and address some of those risks, trying to essentially neutralize the risks and maximize the benefits. And then it suggests, as always, it suggests some areas for further investigation, right? So more research that we all need to do as academics, as policymakers, as practitioners. There's lots to unpack, and so I won't dwell on my introduction any longer, apart from to introduce our wonderful set of speakers. So later on, we'll hear from two different speakers with a unique perspective, Sylvia Prina and Amar Khan. Sylvia is an associate professor in the Department of Economics at Northeastern University. She's a development economist whose research interests are centered on financial access, networks, and spillover effects. And she uses field experiments and other rigorous empirical methods to study the impact of financial access on the welfare and decision-making of the poor. Amar Khan is CEO of Credit Book Financial Services, a digital lender in Pakistan focused on small and medium enterprises. He's been involved in scaling up non-banking financial institutions, especially in microcredit, and has also been involved in the other side, if you like, trying to shape policies pertaining to nano and microcredit as a regulator. Before we hear from Sylvia and Amar, I'm going to introduce two authors of the report, Dan Casera and Ria Sapanta. They'll summarize some of the insights from the report before we hear from our external guests. So Dan Casera is responsible for financial inclusion programs at SIGA, which includes the Digital Credit Observatory, or DCO. Now, the DCO is an 8-year initiative looking at the impacts of digital lending and approaches to designing more responsible and inclusive lending approaches. Before joining SIGA, Dan spent 5 years with, now let me get this right because it's quite a difficult one, Dimensional Fund Advisors, one of the largest investment management firms in the US, and he has a degree from economics from the University of Chicago. Now, Ria Sapanta is our very own research manager from the Financial Inclusion Program, and great to have her here. She has managed research on remittances, women's empowerment, and financial inclusion as well as supported the Consumer Protection Research Initiative here at IPA. Before joining IPA, she spent 3 years working as a social protection and jobs consultant for the World Bank, and she holds a master's in public policy, also from the University of Chicago. So I've probably taken too much time on the intro. I'm going to quickly hand it over to Dan and to Ria to set out some of the highlights from the report. Over to you.
Thanks, Paul. And if it makes you feel any better, folks used to just call it DFA because admittedly, dimensional fund advisors is a bit of a mouthful. So not just you. All right, so while we're getting the screen set up here, all right, I think should be good to go. All right, so thank you, Paul, and appreciate the introduction, appreciate everyone being here this morning. So as Paul mentioned, what we're going to share, Ria and I, is really just a brief kind of overview, just the high-level takeaways from this report that was put together jointly by SIGA and IPA. And really, the motivation for the report, for those that are kind of familiar with digital credit, it won't come as much as a surprise that, starting around a decade ago, we'd seen this really rapid growth in this new type of product, but not much was really known about it. We didn't have a lot of solid evidence. So there was this ongoing debate around what we're going to call sort of the promises and the perils. All right. So on the one hand, we see this opportunity for digitizing credit to expand access. And knowing what we know about credit constraints, particularly for low-income consumers, there was a lot of really promising implications for that as far as improving resilience, reducing poverty, driving economic growth. Now, on the flip side of those promises were the perils, obviously, and that was that we saw a lot of expensive products. There was a lot of anecdotes about consumer abuses, consumers being misled, and in particular of consumers falling into cycles of over-indebtedness where they're taking on more debt more quickly than they can really repay. And so the purpose of the report was, rather than trading back anecdotes, was to bring evidence to bear, to synthesize a body of evidence, to help us really understand what the impacts of digitizing credit have been to date. And therefore, as we look to the future, we know that this is continuing to grow, continuing to happen. Think about the implications going forward. So Ria and I are going to take you through 5 quick sections. I'm going to handle sections 1 and 2 here, kind of bringing some context to the market and going through some rigorous causal evaluations on the impacts and the welfare effects of mobile instant credit. And then Ria is going to take us through some of the evidence we've seen on consumer protection risks and the tools to address consumer protection. And as Paul mentioned, no good research discussion is complete without a summary of kind of what are still the open questions in the roadmap going forward. So to start with, what are we talking about when we talk about mobile instant credit? There's a lot going on this slide, but really the key takeaway is we've seen digital credit growing very rapidly, and you can measure that in a number of different ways. So this center graphic that we have here is showing the amount of credit dispersed, and you can see not only is it growing rapidly, but the rate of growth is increasing across almost every area in the world. You can also look at the fact that the number of adults that are formally borrowing has grown almost 50% between 2014 and 2021, which is the last time that we have data from the Global Findex dataset, or the fact that more than half of mobile money providers are now offering digital loan products, which makes it the most commonly offered non-payment service that mobile money providers offer. So in a lot of ways, we see these products growing very rapidly. And that's going to make it all the more important to understand what's going on. Now, what I'm showing you here, the title slide says digital credit, and the title for the webinar is mobile instant credit. So what we want to do is differentiate this specific type of product from the broader landscape. And I'm going to give you a little bit more in one slide on what we mean by that. So mobile instant credit, we're going to define using each of the 3 words in the full term. So mobile, meaning that the loans are dispersed and repaid remotely through a phone, whether it's a smartphone or a feature phone. And often that means that the data associated with the phone is going to be used in some sort of machine learning algorithm in order to compute credit scores. Instant, meaning that the loans are dispersed immediately, almost always within 24 hours. And the loan terms are correspondingly very short, sometimes as short as a few days, on average, roughly around a month, and generally going to be shorter than more traditional loan products. And then credit. This is really where we're going to, I think, in a lot of ways, differentiate mobile instant credit specifically from other digital credit products. We're thinking about consumption-oriented, small term loans for consumers. Right. And so we'll talk in a second about some other types of products where you're going to have a lot of similar features, but this is really going to distinguish it from some other products, right? And so this should sound familiar to those that are that know the CGAP definition of digital credit as instant, automated, and remote. So very, very similar, but again, really focusing in here on the fact that these are short-term consumption-oriented loans. All right, so I mentioned there's a broad landscape, and really this isn't all inclusive, but just an example of the various types of credit products that are available in the marketplace now. There's a lot of different products that have been digitized. We're going to focus in here on mobile instant credit and airtime loans, which together we're going to sort of consider this first wave of digitizing credit. But as an example, I've highlighted here a couple of other, e-commerce buy now, pay later, pay as you go solar, overdraft facilities. These are other types of products that have been digitized and are a part of what we think of as sort of the second wave. Just as an example to show you why we think it's important to have specific terms and make sure that we're all thinking about the same products when we talk about their impacts and the risks. So throughout the report, as we think about, what are the impacts, the challenges, and the lessons, this is sort of our simple framework that we used. So on the one hand, we know that there have been these really novel, genuine technical innovations that have been brought to bear in this digital credit sort of revolution, if you will. And that's expanded access. It's created new types of products which can meet different sources of demand, and we think that's good. But innovation doesn't translate to impact on its own. We also know that there's been a corresponding rise in consumer harms. And alongside that, we do see some promising approaches to protecting consumers, and Ria's going to talk about both of these things, but whether they can be implemented at scale, still unknown. And so, not to bury the lead, but essentially what we find throughout the report is that this first wave of digital credit products has had some modest upside, but has carried significant risk. And so as we think to the future, it's important to understand how we can translate what we've learned into better design. And in a lot of ways, we think we're going to advocate for is that means productive economic activities, right? So I mentioned these loans are often for consumption-oriented purposes, and I'll show you some data on that in a minute. But can we design products that are better suited for productive activity? Can we scale up some of these innovations that seem to be promising as it comes to market monitoring, regulation, consumer protection? And so that's still uncertain, and that's really the job of all of us on the call here today, is to help move in that direction. So for the next section, we'll look at some studies that are trying to measure what are the welfare effects of mobile instant credit. And so these are the 6 main studies that we looked at in the report. You'll see the first 4 here are on mobile instant credit, and the bottom 2 are on airtime loans. I mentioned, we're going to kind of consider these jointly as part of this first wave. A couple of things I'll point out from the table. First and foremost, we see generally high take-up rates, and that's going to differentiate these products in many ways from more traditional loan products, or things that came earlier, things like microfinance, where we typically saw lower take-up rates. Small average loan sizes. So for most of these products, the average loans are just a few dollars. And the default rates are varying, but in general are on the higher end as compared to other traditional loan products or microfinance. So before I jump into summarizing what we saw as the impacts, just to give you a sense of consumers that are using these products, what are their alternatives? Because we think that's important context to evaluate the impacts. It's sort of a busy chart on the top here, but for 4 of those 6 studies I just showed you, we have data from participants in the study on the other sources of credit they have access to. So we're showing you here on the left take-up rates for those relevant studies, one in Malawi, one in Nigeria, one in Kenya, and one in Haiti. And then we're showing you here sort of organized roughly from more formal loan sources towards less, what other source of credit people used in the last 3 to 6 months, depending upon the study. And the main takeaway here you can kind of see is if people aren't using other digital lending products, the only source of credit that they consistently seem to have access to is informal credit through friends and family. Sorry, did not mean to go forward there. Is informal credit through friends and family. And so that's important context as we think about, again, how these products can be expanding access. And I really like the statistic here in the bottom right, 37 percentage points. This comes from a study in Nigeria where a subset of individuals that applied for loans were automatically approved rather than going through the standard screening process. And those that would have otherwise been denied a loan, had they been gone through the process, were 37 percentage points more likely to have a loan from any source. Not just from the lender in the study, where obviously you'd expect to see an increase in access if you're automatically approving people, but across any source. And so that would include friends and family or other lenders. And so, again, this is just one study, but it is evidence that this approach can genuinely help expand access. Now, in terms of how people are using the loans, we have 3 studies here where we have data on that. And the studies ask the questions in slightly different ways. So these are not exactly apples to apples comparisons, but some broad trends emerge. What we've done is color-coded each of these type of uses based off of whether they're consumption, and this sort of rust color, if you will, business in the dark blue, emergency and transfer in the light blue, and other in this light gray. And the main takeaway here is that the color palette sort of skews towards this rust color, towards consumption. So 2/3 to 3/4 of the use cases that people reported taking out these loans for were consumption oriented. Now, we understand particularly with a lot of low-income consumers that might have informal businesses, there is sort of a blending often of kind of the household balance sheet and the business balance sheet, if you will. So it is a little tricky to interpret these numbers, but the evidence that we have does suggest that by and large, consumers are using these for consumption. And so that's important as we try to think about both what are the impacts of these products and what can we expect impacts of other products to be. And so my final slide before I turn it over to Ria is just summarizing what we found those impacts to be. So for each of these 6 studies, we looked across a number of impact metrics. And in a second, I'm going to flip this and show you if we found positive, negative, or neutral effects. And I want you to just take a moment here to think for yourself what you're expecting that to look like. And so the thing that surprised a lot of people, whether they're proponents of credit or critics of it, is how much gray sort of neutral effects we found. I think a lot of people that expect these products to be harmful are surprised that there's not more red, and those that are proponents are surprised there's not more green. But by and large, we found pretty modest effects just on real financial outcomes, things like consumption, assets, financial health. We did not find really much of an effect at all. The one area where there were consistently positive results was on subjective well-being. And we had a number of studies that looked at the interaction between credit and gender and didn't find many effects one direction or the other that women were disproportionately harmed or helped. And so again, this goes back to that takeaway that we saw modest upside in terms of the welfare impacts. And now I'm going to turn it over to Ria to kind of dig into the other side of that in terms of the rise of harms.
Thank you, Dan. So as Dan has mentioned, I'll be talking about another stream of evidence, which relates to the misconduct associated with digital credit. Whereas Dan's discussion presented welfare impacts of digital credit as almost close to a mixed bag, the evidence on consumer risks are quite clear and robust, in that we see that the consumer risks are growing and significant. So going back to the debate introduced at the start of the presentation, the evidence on consumer protection seems to suggest that mobile instant credit has not been doing a very great job of helping consumers. To help us understand, the box on the right hand of your screen shows a framework of how we can think about the variety of consumer protection risks, organizing them into 6 buckets. Some risks are done purposely, such as fraud, scams, post-contract exploitation, while some risks are a result of imperfect information and one's own decision-making limitations. When thinking about what policymakers should do, the key takeaway here really is that a broader set of evidence of digital credit should be considered in decision-making. This means not only taking into account the causal studies that Dan has mentioned that have not found clear negative impacts of mobile instant credit, but also the evidence from both causal and descriptive studies, suggesting a variety of consumer protection challenges that should inform the policy moving forward. So the next slide, I'll be discussing some of the evidence that we found in the studies that we've seen so far. Firstly, talking about the high fees. So the table on the upper left of your screen shows a snapshot of the fees and terms of some of the biggest mobile instant credit products in the market. One can see that the fees are very high, and as a point of reference, when these are analyzed, we're talking about rates that are over 100%. And despite the high prices, they are also very popular. Part of this RCT study done in Malawi, the authors asked detailed information on what the sources of credit are for the respondents. And we see that digital and airtime loans are the most common, with over half of the respondents taking at least one of this source of loan in the past 3 months. And we're talking about an even higher APR here of over 1,000%. One factor contributing to the high prices is the agent overcharging. There's evidence that agents deviate from the FSP pricing and charge extra fees. We see here some evidence from a consumer protection survey in Nigeria, where there was a common experience of agent overcharging and unexpected or unclear fees for over a third of the respondents. This is consistent with some evidence, recent evidence we found, and this is based on an IPA study done recently on the mystery shopping exercise, that found that agent overcharging is twice as high in Uganda as it is in Tanzania and Bangladesh. Consumers also reported to be a subject of fraud and scams. This is an interesting data here using metadata scraped from fintech apps from the Google Play Store. And researchers manually classify the apps in these countries according to their compliance to local lending regulations. And what we found here is that majority of them are quite problematic, as about more than 2/3 of these apps are classified as predatory and pure fraud. And this is particularly high in US and India. The next slide shows some evidence of debt stress. The ease of access to expensive credit can lead to high default rates and the cycle of indebtedness. First, we show here in the left side of the screen some statistics on the loan default rates by provider, and we see that mobile banking and digital loans incur the highest default rates. And the table on the lower left shows administrative data from another IPA study also in Kenya, wherein multiple borrowers across providers incur the highest rates of late payments and default rates when compared to other consumer segments. So when you look at these numbers, what can think about the role that policymakers can play? And it suggests driving policy towards the sharing of information of credit bureaus. So getting access to one's own customers' data is much easier than obtaining information from other borrowers, and policymakers can step in to facilitate that cross-share. And on the right hand of the screen, we see some illustrations on the cycle of indebtedness. So the ease of access of credit with financially inexperienced borrowers induce credit that leads to overborrowing and vicious cycles of debt. So these defaulters get reported to the credit reference bureaus, which would then impact their loan applications, causing interest rates to rise and making the cost of borrowing just even more expensive for these borrowers. And going back again to the debate that we have on digital credit, people are actually making sacrifices to repay mobile loans. Based on the survey, also from Kenya, we see that reduced expenditures on food are the most common sacrifice that people make to repay the loans. So overall, these evidence do not fit the narrative of digital credit being a transformative tool of poverty alleviation. After talking about some of the evidence and the risks, I do want to spend some time talking about like evidence on the effects of consumer protection tools. So there has been a handful of pilot interventions and causal studies that confirm promising new approaches to protect and empower consumers. And really, we could classify these into two buckets. The first one is on market monitoring solutions for regulators, and the second one is on direct-to-consumer interventions. The first one, we're talking about rich new data sources, sophisticated data collection methods like the mystery shopping that I mentioned, and advanced data analytics. All these suggest a next generation approach to market monitoring that would enable regulators to push beyond retrospective intervention and more towards preventative. In addition, recent evaluations have shown evidence on what are and are not promising approaches to empowering consumers, especially during the next waves of financial digitization. So the next slide basically just categorizes these interventions according to the type of consumer protection risk as discussed earlier. And the ones highlighted in orange are the ones that we have detailed evidence of. And I encourage you all to really look at the tech to be able to understand these evidence. And as always, the idea is that these are supported by market monitoring approaches as listed down here. So at the end of the presentation, I want to discuss some open questions and key takeaways. So while we have made progress in terms of what we know so far about digital credit, there's still some areas where more data and information is urgently needed on mobile instant credit. On your thinking product design, for example, what solutions do we have on restructuring mobile instant credit loans so that it's incentive compatible for both consumers and providers? What are the most effective and practical ways of standardizing communication on the cost of the MIC? Another big question relates to the welfare effects of the newer wave of digital instant credit. Not much research has been done on the relative costs and impacts and risks of the new products that Dan has mentioned, and the buy now, pay later schemes and mobile money overdraft facilities, which have been increasingly popular. Another question is on how digitization can usher in the transition from consumptive credit to more productive uses. And on the regulatory side, consumer protection, we have questions on how should we reform regulation and improve redress? Can traditional information and product disclosure approaches improve consumer outcomes when applied in digital credit market, so on, so forth. So to end the slide, just to summarize the key takeaways that we've discussed so far. First, we've shown the limited impacts of digital mobile instant credit, in particular in terms of welfare, as Dan has discussed. We've also talked about some urgent challenges on consumer protection. We talked about some evidence on the debt stress, the high prices and fraud and scams. And we've also covered some of the promising solutions, which we categorized earlier, and market monitoring, as well as direct-to-consumer interventions that providers can use. Now, I want to end by emphasizing like two main things in terms of policy and outlook. The first one is that more research is really needed to be employed in order to understand the many emergent forms of digital credit, such as the buy now, pay later schemes and overdraft products, and who benefits from it and why. Credit products focus on productive activities also remain unexplored. This is key as regulatory frameworks are still being developed in many countries around the world, leaving consumers at risk. And the second is that despite what remains to be known, and just to end on a positive note, there are a lot of reasons to be optimistic. huge part of it is the evidence that we know now. Digitization has catalyzed rapid growth in financial inclusion, and addressing known policy issues now can be instructive for informing management and regulation of digital credit products, including the potential transition of digital credit into more productive parts of the economy, which I think is the overall hope and trend that we are looking for. So later we will hear from Amar and Sylvia on some reflections that they have from a provider and researcher perspective on how we should think about the next wave of digital credit. So I will turn it over to Paul now to open the panel discussion.
Thanks, Ria. And unfortunately, I can't join you in video mode. For some reason, I can't find the right button to click. But in any case, I'm only here briefly to say thank you to Dan and Ria for the excellent presentation. To encourage everyone joining the webinar to add your questions in the chat. And we'll try and get to those. We've already had a couple. We'll answer some of them live after later on in the Q&A. Before we get to the Q&A, we have Amar Khan and Sylvia Prina to give their thoughts and reflections, some of their unique perspective on what we've just heard from Dan and Ria. So first, over to Amar. Love to hear your thoughts as a practitioner in this space.
Thank you, Paul. It was a great presentation, guys. Thank you very much for this. I'll just give a brief overview of how I see all of this as a practitioner. So one thing that we have observed in micro and nano credit is that the ticket sizes are small and the loans are mostly used for consumption smoothing. So this is a critical component. The borrowers only take out loans when there is some sort of consumption gap that occurs. That can be due to delayed wages, that can be due to delay in availability of work, that can be due to other or any kind of shocks. So they use these loans to smooth out their consumption. However, what happens is once they smooth out this consumption, they're essentially stuck in this, I would say, debt trap, if that is the right word. They keep on taking more and more loans till the time they're not able to service those loans and essentially they default. And that is why we see significantly high default rates on a lot of these loans, in some cases even more than 50%. So something that starts with consumption smoothing eventually leads to default. And this is why I would assume here, the welfare effects also either remain neutral or they remain low, mainly because the default rates are high, and that leads to some kind of, I would say, a psychological impact where, well, we've seen in many cases in Pakistan where people simply just turn away from loans because they're too scared of loans, and that just delves into the whole consumer protection and predatory lending space, where in certain cases, the market practitioners are so aggressive in terms of recoveries or in terms of interest rates that people really get scared. I would say even last year, there were even a few suicides, it may get a bit dark here, that happened mainly because of predatory lending apps, due to which the regulator had to step in and really do a massive crackdown on all of these apps. One of the slides in the presentation clearly pointed out that a significant number of apps, digital lending apps, were essentially predatory in nature. And because the distribution channel became so easy, like you can simply create a new app, upload it to the Play Store, it can mimic a formal financial institution, and you can start lending out loans and have a very aggressive call center or collections unit in place to essentially start, let's say, threatening people or just essentially try to get as much recovery as possible. So a lot of these things led to a negative welfare impact, and that led to a lot of people actually shunning digital credit in the process. Now, one thing that has actually come out, I would say the silver lining here, the regulators in many of these markets have started taking a note of these, and they are structuring regulations or framing regulations in a way that more structured players or more structured participants can come in and essentially provide a more, I would say, user-friendly or consumer-friendly service. One of the things that regulators are doing is essentially capping the rates or the interest rates that these loan apps or lenders can charge. Another important thing here, which I believe hasn't really been covered in detail in the presentation, but it is covered in the study, is that the interest rate is not just in terms of APR or the annual rate. There are a lot of fees that are layered on top as well. And that leads to more, I would say, confusion on part of the borrower, because again, these borrowers are not the most suave in terms of financial literacy. So they just don't understand. You can tell them, you can advertise in the sense, oh, you know what, this is an interest-free loan. Technically, there may be zero interest rate, but they will charge you a very high upfront fee. And suddenly the user will be hit with an upfront fee. So a lot of communication issues, a lot of issues regarding consumer protection also led to some serious problems in these cases. And that is why we see the welfare effect largely being negative in most of these loans. I would say that over the last 10 years or 8 years, if you track the trajectory, it's been only in the last few years, since 21, 22, that digital adoption or digital lending of nano loans really took scaled up, and that led to a lot of let's say consumer problems as well, and that led to subsequent rationalization of regulations and more consumer protection as well. In fact, one of the studies this study I shared with the regulator as well, with the regulator in Pakistan, is on how we can actually improve the overall consumer protection environment for nano loans and microcredit in Pakistan. So definitely this is a very strong impact in terms of how regulations are shaped and how digital lending is shaped. What can be done going forward, or what is in the next wave of digital credit? I just feel that, and think the authors have also said the same as well, there needs to be a switch or a transition towards more productive loans as well. But how do we do productive loans? How do we distinguish the personal balance sheet from a business balance sheet? So a lot of, let's say, what I call anchor customers or anchor corporates, there are big corporates out there, there are big businesses out there who have small businesses a part of their value chain, a part of their supply chain. It is through financing that value chain that we can essentially do productive loan building. For example, there are a number of institutions in Pakistan which are essentially giving out loans for supplier financing, or something like very micro invoice discounting, or micro supplier or micro vendor financing. So in this way, the loan is essentially contingent on a productive activity being conducted. One thing that we have observed in this case is that the default rate suddenly reduces. Why? Because the loan is not being used for consumption smoothing at this point. The loan is actually being used for productive activity. And when the productive activity happens, it essentially leads to better welfare outcomes. Yes, there are defaults in that as well, but the willful defaults have suddenly reduced. More importantly, pricing those loans in a way that aligns with the supply, with the margins available in the supply chain, ensures that the borrower essentially is not really, I would say, pressured or pushed under the burden of higher interest rates. So one thing going forward that we may see is essentially more variable rate loans, more dynamic loans that are linked to the supply chain, and how the pricing for different loans may vary depending on their position in the supply chain. Through this, I just feel the infrastructure that has been created for consumer-led financing, whether that's for mobile airtime, whether that's for something else, can be used for productive purposes as well. A subsequent iteration of evolution of mobile airtime is essentially mobile remittances. There are a lot of remittances that continue to move around. Let's say in the case of Pakistan, there are a lot of domestic remittances. People working in urban centers sending back money to their families in the semi-urban or the rural areas. Now, there are many agents out there. Agents have a very high load. Agents have like hundreds of users coming on a daily basis. So financing those agents in a way that they're able to meet that demand, that is, I would say, a second stream, or let's say a subsequent iteration of mobile airtime. So I just feel after the whole default wave, we will see movement or transition towards more productive loans, where the loans are more structured rather than being typical vanilla loans where they're used for consumption smoothing. Yes, well, I believe I went up time limit here.
No problem, Amar. Thank you very much for those insights. And now you've got my face back, which may or may not be pleasing for some people, but I'll go away in a minute. I'm only here to introduce Sylvia, who's going to give her perspective as a as an academic and to hear more from her research in this area. Thank you.
Yeah. No, thank you. Thank you all for inviting me to join this panel. It was really exciting to see the report and to see that really consistently research aligned with the fact that while there appear to be no negative effects, the welfare impacts are actually quite modest. One insight that I think it's particularly noteworthy, which aligns with what Amar has highlighted as well, is the fact that the default rates are extremely high. I mean, 46.3, in the report was very, very high. And so trying to better understand how, why is it that this happens, and design product that then somewhat take from those insights, I think it's going to be incredibly important. And I mean, Amar highlighted challenges in terms of, and so did the report, in terms of consumer protection, not just because of the predatory lending, payday loan in the modern eras, but also fraud and a lot of debt stress that was emphasized by Amar as well, that then leads ultimately to defaulting. In terms of the landscape has been changing over time, and one of the things that I've experienced, unfortunately, I'd say, as a researcher, has been that regulatory requirement to share data have gotten really tight, and this is incredibly important because the sensitivity around data might actually be a negative externality for consumer protection regulation. We need data to be able to better understand why is it the defaults are so high, and to be able to then create forge partnerships, which as a result of these regulatory requirement to share data have become increasingly difficult to forge with digital lenders. So I think that this has been a bit of a change in recent years that has made it a little bit more difficult and longer in terms of developing memorandum of understanding, non-disclosure agreement with digital lenders, and so a longer time span before carrying out a project. One thing that I like to highlight is in terms of what I think could be relatively low-hanging fruit in terms of product design that could be I think most impactful, particularly in these realm of really high interest rate, and somewhat along the line that Amar was highlighting in terms of trying to design digital loans or mobile loans that are for productive type of investment. So the way I see it as a researcher, people might get mobile instant credit for broadly two different groups of categories of loan. On one side, the way I see it is that there is what we call instantaneous consumption, whether it is a bet or you see something that you really like and you want to buy it right away, or it could also be an emergency, right? And so in those cases, really time, it's an issue, and so you really want to get a loan sooner. Then there are other type of expenditures that are more planned expenditures. You know that your school fees are going to be up September, for example, or it could be an actual productive investment. In those cases, there is a planning behind, and therefore if you plan ahead, which might not be an enormous amount of time, but it's definitely very different from instantaneous consumption, and therefore these, in my view, opens up the possibility of somewhat being better able like to discriminate our digital borrowers based on quote unquote like the need for speed, meaning that for instantaneous consumption or for an emergency where like you really need the loan as soon as possible, then lenders could actually like charge for speed like a much higher like interest rate, while instead if borrowers are willing like to wait maybe until like the day after or so, then that would qualify more as a planned expenditure or like as an investment, and therefore like the interest rate like would be lower. This is very much like similar like to discrimination or like seats on a plane depending on economy plus or whatever, but this would be like a low cost like change in like product offerings which could improve like borrowers' outcome if done correctly. In the realms of like still trying to address like defaults and like trying to lower like defaults, other relatively like low cost changes like to product design could include like repayment plans, where like by repayment plans I think not just to inform like consumer about the fact that, I mean, often there isn't just an interest rate, or maybe like you're told that the interest rate is 0, but there are a lot of like built-in fees, right? And so structuring like a repayment plan will actually like enable people to actually see how much they will have to repay, and people could select like a given frequency of like repayment and would be able like to see the amount that they will have to repay like every week. This is somewhat like a project that it's in the making, along with another project that deals with defaulters that are actually like informed that they'll be able like to regain like eligibility. So even playing with the possibility of like regaining like eligibility for future loans could be one way of eventually like trying to tackle like defaults. Let me just conclude with one last topic that I think is incredibly like important. It's about like reporting like to regulators or like credit bureaus. Currently like in the landscape, there are huge differences, like even within like sub-Saharan Africa, like country to country. In some cases there is a requirement, in other cases like there isn't. In some others, like countries are kind of like thinking about it. I think that it's going to be incredibly interesting to see how countries like go about it, and what is it that certain countries like learn even like from others in terms of like regulatory requirements. And happy to talk more like with practitioner, anybody. Yeah.
Great, thanks, Sylvia. And the Q&A, having been silent for the first half hour, is really starting to take off. So I really appreciate everyone's questions. I'm going to try and parcel a few of them up, because there are a few that are sort of pointing in the same direction. And it really started from Chibazor and the point that they made at the start around credit risk. How do you manage firms who perhaps are lending, essentially lending too much to individuals, leading to high debt? And that comes to your point, Sylvia, about credit bureaus as well. On the other hand, we have questions from Mary and Juan Carlos about consumption smoothing, and from the sort of demand side, how are consumers perhaps over-consuming, and what is the role of firms or regulators in curbing some of that, and also what are the solutions, right? So Juan Carlos mentions the need for products that help people build savings. And then finally, this also brings in a point from Prince, where he asks, okay, this is a two-sided problem. How much is this coming from bad lending practices from firms versus sort of demand side problems of irrational consumer behavior, sort of behavioral biases, not thinking through those purchases? Those are tricky issues. I know from my own sort of perspective as a former regulator, those are difficult to deal with. But I wanted to throw it back first to the report authors, if there's anything they would like to say on the balance of these two things. And then I'll come back to Omar and Sylvia to get their perspective on these questions.
Yeah, I can jump in, and then Rhea, if I miss anything, please add on here. So that's like 4 or 5 questions you packaged into one, so I will do my best here. But I think in the questions, one of the themes I sort of saw was essentially, as you hit on, the supplies versus the demand side. And Juan Carlos in particularly pointing out like, hey, should we be dictating what consumers are doing? And I want to be clear, when we say that we're advocating for more of a shift towards more productive type of loans, that's not necessarily saying that we think demand should change, but rather that advocating for lenders to think more clearly about product design for the productive side, and on the regulatory side to think about how to facilitate some of those things. When it comes to like what are some of the safeguards that can be put up, I think one of the studies that we funded that Sylvia was a part of had some interesting findings around what CGAP recently kind of called positive frictions, right? So, the example outside of lending there is you go to send an email and you use the word attachment, but you didn't attach anything. You might get a pop-up that says, hey, did you mean to attach something here? And so it adds a little friction before you send the email. But if you actually meant to attach something and you didn't, you really appreciate that friction. And so are there ways that we can think about adding those sorts of frictions into the lending process? We've seen some early evidence that can help improve consumer outcomes by slowing people down, making sure they really understand the terms and conditions before they take out the loans. We don't fully understand all of the mechanisms, but we have seen empirically that there's some positive benefits there. And then I guess the last thing I would say, Sylvia hit on at the end there, what we could potentially see from more kind of uniform credit reporting, even when there is sort of standards that people report, those standards aren't consistent. Sometimes what we're seeing is you're only reported for bad behavior, but you're not reported for good behavior. And so it's sort of asymmetrical, and having a more consistent way for people to get credit for good borrower behavior is another way I think that's sort of underappreciated to potentially help lower costs and get people access to cheaper loans. So I don't think I fully answered any of the questions, but I tried to touch on several of them. So I'll pause there so let's not take up all of the air in the room.
Yeah. And Paul, yeah, just to add what Dan has discussed, and probably I'm not doing a best job as well in answering each of and every question, but just to cover some of the areas pointed out in the chat. I think one question was about the debate on whether the MIC is mostly caused by the demand or the supply side. I think that the evidence isn't really clear on like one being the higher reason of the MIC consumptive uses. But one thing that I want to say is that I think when it comes to looking at the different credit sources, one should think about what is the counterfactual. If not the mobile credit loans, what would be the other sources of credit of these consumers? If it's banks, formal institutions, we do know that this has high barrier of entry with the multiple documents that they'd have to submit, as well as the long times of processing. So while the default rates are lower, the cost of borrowing or the entry costs are higher for this types of formal institutions. Whereas if they do borrow from friends or families, it's easier in terms of access, but it's higher default rates compared to banks. So I think that's one thing that we should keep in mind in terms of the question of, like what would be the best source of loans, right? Like thinking about the counterfactual and the other alternatives present to the consumers. I think one thing that I want to add in terms of there's been a lot of discussion on cross-sharing information across credit reference bureaus. And I think I do want to point out like some interesting methods that have shown up in the evidence so far in consumer protection, and that would include like innovations and market monitoring of data such as the local mystery shopping exercise done by IPA, wherein intercept surveys, professional shoppers were deployed in order to get a sense of the true cost of transactions in the field. And so, on top of the solutions that we mentioned on the sharing of information, there are some innovations that we see in the data collection side that could help market monitoring for regulators.
Great, thanks, Ria and Dan. I'm going to be more specific now with my questions then. And first, turning to Amar, we have a question from Mary. It's a related point really about, how do we, you were mentioning something about how do we curb consumption smoothing. And yeah, it's a bit of a, how do we go about that as policymakers, as regulators, and how should firms respond?
Yeah, I think one way to do that is essentially through embedding in the supply chain. For example, you can have a retailer and you can have a small retailer, and that retailer is essentially buying goods from someone and selling goods to people. So financing those goods, that goods value chain is one way to do that. Another way to do that can essentially be financing remittances. A certain household receives 6 remittances every month or every 2 weeks. There is a certain data pattern in there. Financing against those remittance receivables, because so you have some kind of data point that says, okay, you know what, these guys are going to receive certain remittances, and this is how the loan can be repaid through that. Some classic invoice factoring or essentially remittance factoring in this case. Someone mentioned solar here. Financing solar panels, adjusting the same against the utility bills that exist. The utility bills provide great source of, I would say, source of truth for credit scoring. How have they been with their overall bill payments, so on and so forth, and how much can they save money by having solar panels installed? So there are a number of ways to essentially move away from consumption smoothing, but that would require utilizing a lot of alternative data, utilizing data that pertains to the supply chain. So I just feel we will see a lot of product expansion, specifically moving away from just airtime loans and instant credits to more embedding within the supply chain and within different products that an individual or a business can buy that can actually increase their incomes over a 3 to 6 month period.
Great, thanks, Amar. And that sort of also bridges that gap between consumption credit and productive credit a little bit. Now, final word over to Sylvia. Coming back to the question about demand versus supply, right? Is this a demand side problem or a supply side problem? What's your view?
It's complicated because oftentimes I think there is a misconnect between what consumer or small and medium enterprises, entrepreneurs would like as a product and what's being offered. And that's why some of my discussion touch based on product designs and trying to figure out potentially for planned expenditures and so slightly better deals to entrepreneurs or even just households that are planning I don't know, to remake the roof or pay for school expenditures and so it's really hard to say whether I think it's both, right? And right now, I mean, the way I see it is that there has been a lot of push on speed, but speed is not the only thing that we need, as Amar pointed out as well. And let me just close with one of the things that Dan pointed out related to credit bureau and credit reports. Currently, at least considering the general landscape within a country where there might be multiple provider of such type of loans, if there is a report like to the credit bureau, it's only like for the bad cases, right? In a lot of countries. And so what this like creates, it's actually like just like a punishment like for the bad one, but there is no reward actually like for the quote unquote like good borrowers. And part of it could also be due to a push like from the supply side, meaning that you don't want to report to the credit bureau because then that becomes like public information who the good borrowers are, because you don't want them like to be stolen from you by other potential lender. But that also implies that these other potential lenders cannot get then like better deals because it doesn't really like increase competitions for them. So it's complicated and in terms of like an issue. And again, is there are like demands from borrowers, but then the supply could be limited or is limited in the interest of like particularly like big players. Yes.
Great. Thanks, Sylvia. Lots to unpack. We were never going to be able to cover everything in 1 hour. We've gone slightly over. I really want to say thank you and my big appreciation to the two authors we have today, Ria Zapanta and Dan Casara, and especially to Amar Khan and Sylvia Prina for their involvement. Thanks to Lauren for organizing in the background. She's been great. And thanks to all of you for tuning in and listening to the discussion so far. I hope it's given you lots of food for thought. Clearly, lots more to do to maximize the benefits and minimize the risks. The presentation, the report, and this webinar will all be, well, the report is already available, but this webinar will be made available to anyone who signed up. So thank you very much. We'll end it here and enjoy the rest of your day.